In the last part of this video, we'll discuss more of the services. Again, more of a structural question, I guess, of what are the things that you get when you buy a mutual fund that you wouldn't find if you were just buying regular stocks and bonds. In addition, we'll talk about calculating returns, etc. So, first of all, what kind of service do you get? One of the services you receive is an automatic investment plan. Now, what this allows you to do is to set up an automatic withdrawal from your paycheck and or from your bank account that goes right into the mutual fund every month. And this could be, for some mutual funds, could be as small as $25. So this is a way that you can get money to come out automatically. And obviously the growth happens, and I guess if you don't see it, you won't miss it. So it's just a way to put this, there's a phrase that's referred to as, paying yourself first. So the very first paycheck of the month, you pay yourself $100, and that goes into your retirement account or into an investment account. Automatic reinvestment plans allows compound return to happen. And this really is the default for most mutual funds, that they will automatically reinvest your capital gains and income. And if you want to get the cash, you specifically have to request that to happen. So this allows compound return to happen. Remember, if you don't reinvest it, then that earnings cannot itself earn more return over time. So we need to have a way, obviously, to do this. And they will do this typically with no charge. So there's no sales charge. The money automatically goes in. And the impact can be dramatic. If you take a $10,000 investment in the S&P 500 from 1988 roughly to 2015, the red line represents what happens if you don't reinvest. And if you reinvest dividends, you end up with, quite frankly, it's almost double the amount of money in that same time frame. So the value of compound interest can never be taken lightly. It's a very important goal that you want to achieve, and this reinvestment makes that much easier with mutual funds than it would be for stocks and bonds. There are systematic withdrawal plans. I mean, this is something that we may want to look at once we get to retirement. You're going to want to get money every month during retirement. If your money is in a mutual fund, you can tell them specifically how much money to send you every month. And again, it could be as low as $50 or more. This even could be used, let's say it's used to pay off a loan, right? So let's say you have a car loan. The car loan's $200 a month. And let's say that you get an inheritance and you get a $50,000 inheritance. Well, you could just take some of that money and pay off the loan. That would work. Or you could put it into a mutual fund and then have the mutual fund make the payments. And at the same time, the mutual fund is going to earn earnings. So if the interest on your loan is 3%, but the mutual fund can earn 12%, the money will actually grow faster than the money coming out. So you may actually be able to, in quotes, pay for the car for nothing, because it's all going to be paid from the interest from a mutual fund. So it's a tool that's available for us. Conversion privileges allow us to move and manage our mutual funds within a fund family. So if you're invested, just to pick one, everybody in the Cincinnati area is familiar with Fidelity. So if you have a Fidelity mutual fund in stocks and you're worried about the stock market and you say, I'd like to move some of that stock money into the bond market. So you can convert some of your stock mutual fund into a bond mutual fund. Now, typically you can do this. It's just it's just managing your portfolio. But typically you can do that without a sales charge. Now, since you are technically selling one mutual fund and buying another, this could trigger some capital gains. So there could be some taxes that are involved. But in general, it's a way to do this without a sales charge to manage your asset allocation. Now, if this is within an IRA and a retirement account, there are no taxes. So you actually do this tax-free if it's in a retirement account. So again, as I mentioned, this is they offer retirement programs, and a lot of these things that we've been talking about, these services, fit very nicely into retirement programs. So there are businesses that have small business retirement accounts, and those can be funded very nicely through mutual funds and through IRAs and 401ks. So it's possible to, if you kind of think about this, of all the mutual funds, again, as they mentioned earlier, worldwide there's 79,000 mutual funds, right? Even if you think about in the United States, roughly it's 10,000. So you have 10,000 mutual funds. How do you figure out where to put your money, right? The idea is, since mutual funds have objectives, and you know what those objectives are, you can identify certain areas. So let's say you would like to put half of your money in stock funds. Well, while you're thinking about stock funds, you don't have to think about all the other kind of funds. All you're going to do is look at stock funds. And you say, okay, I only want to invest of those stock funds, right? Half my money is in stock funds. I want to put 80% of that into the United States market, and I want to put 20% in the international market. So you can narrow down the number of funds to look at by trying to decide the different categories of funds to buy. Now, when you are investing in mutual funds, you typically want to pick a fund family that has lots of choices. So a mutual fund family that only has 4 choices would not allow or permit very efficient asset allocation, since it has very few choices. So you probably want to have a mutual fund that has maybe several hundred different types of mutual funds that it manages. Of course, you want to try to accumulate wealth. That's one of your strategies, right? So you want to use this for the long haul, build up, reinvest capital gains, and reinvest income. Just as a storehouse of value, right? You want to have a place where your money where you can feel it's fairly secure. So there's lots of funds that are relatively low risk, short-term and short and intermediate-term bond funds, money farms funds. Those are all funds that can help you with storing value and maintaining your capital. Just a brief word about speculation and short-term tradings, right? Investors may aggressively trade in and out of mutual funds, and they may use them as long-term investment, but they may want to follow some aggressive trading strategies. There are funds that allow this, but in general, the definition of a mutual fund is a long-term investment. The fees are set up so that trading and moving, although if within a fund, because of conversion feature, you can do that very low risk, right, and a little bit of a very little cost, maybe taxes, but low cost. You do want to understand that most mutual fund managers are thinking about long-term investing. So if your approach to mutual funds is to be speculative and to trade short-term, your strategy is contrary to the strategy of the people who are managing the money. So typically short-term trading in mutual funds is kind of it's like an oxymoron. You really don't really want to do that. So in the process, how do you do this, right? How do you invest in them, right? We need to determine first of all, if you want to use mutual funds in a portfolio. We know that it increases diversification, that gives us some expertise that we may not have. And of course, we can use stocks and mutual funds. You don't have to exclusively have mutual funds. You can combine them with certain stocks. But if you're using these funds, right, remember, compare the investment objective to your objective, right? You have to understand about your risk tolerance, of course. What is the intended use, right? Are you thinking about wealth accumulation or value capital preservation, right? And what are the services and the costs of services that are offered? So the process of asking and figuring out which mutual fund to use is a little bit difficult to do since there's so many. However, there are sites that will help us with this. One of the best sites that I found is Morningstar.com, and Morningstar.com provides some screening tools. It provides education on mutual funds. So it's a great place to go to find information specifically about mutual funds. And even then, it also gives us information about bonds and stocks, etc. But they concentrate, they're, in quotes, best known, if you will, for their for their mutual fund information. So how do we do this? How do you whittle down, what to invest in, right? You need to know something about performance, right? That's obvious. Tax efficiency is a good question. You don't want to be taxed out of existence, right? If you remember the phrase I've been using throughout many of my videos, it's not how much money you make, it's how much money you keep that counts. So you want to find and make comparisons of tax efficiency. You want to look at the fee structure. How does this fit into your portfolio? What are the skills of the fund managers? Right? Do you want to give money to a money manager who only has 2 years of experience, or would you rather be giving that to a fund manager that has 15 or 20 years? You need to choose between load and no load funds, closed end and open end. So there are lots of choices, right, to try to figure out what to do. Your textbook says you should stick with no loads and low load funds. The empirical results, they say, generally do not support the idea that load funds provide added value. So as a maximum, as a rule, to maximize returns, you should consider sticking to these no loads or low load funds. Actually, you want to understand more than the load, right? The load is not the most important part, right? No loads and low load funds may charge higher total expenses. So we have to understand, right? Which would you rather pay? Would you rather pay a load today and low expenses forever, or would you rather just pay higher expenses forever? Right? So no load funds typically have higher management fees in general than what you might think of as one that has a load fee. So again, we need to address all of the expenses, not just the loads. So some of the key differences between closed-end and open-end funds, if we want to think about moving into the return sphere, right? Brokerage commissions are applied to closed-end funds. Guess what? There are also commissions applied to open-end funds. Open-end funds have a little bit greater liquidity. All you have to do is send your money back, or send an email back, and you can sell your funds almost immediately. Closed-end funds typically don't have a full range of services like open-end funds. Closed-end funds may trade at something different than NAV. So the premium or the discount that you pay is the share price minus NAV divided by NEV. right? So essentially, we need to understand what is this discount, or what is the premium? What is causing this? And it says here, as a general rule, these closed-end funds trade at discounts. So you're paying something less than what the net asset value is. And if that's true, that's great, but now you have to be able to identify what those premiums are. So here we have some funds, right? Here are the premiums, and you see going down the list here, most of these are negative. So if you buy this first, what is this, Tekla Life Sciences Investors, right? It has a negative 0.193% discount. The market yield is about 18.97. The NAV return is 19.9. On average, the 3-year standard deviation is 15.3. So we can, from this, calculate a Sharpe ratio, right? We can calculate in general what the Sharpe ratio might be. Tells us about volume, tells us about assets, right? What's the tenure of the manager? In this case, there's a 12.5-year tenure, right? This manager, the management team, has been there for 12.5 years. You look down here, let's go down here. We have this company here. This is Aberdeen Japan Equity Fund, much higher discount, right? Returns a little bit lower, standard deviations a little bit lower, right? We also look over here, the management team's only been there for 1.3 years. So as a general rule, myself, I would like them to have at least 5 years experience. That way they get to see a little bit of both, maybe an upswing in the cycle and a downswing in the cycle. So if you're looking for a closed-end fund, what are we going to look for? Again, we're looking for the size of the premium and discounts, right? Funds trading at deep discounts can enhance your returns, but we do have to worry about why is the discount so deep, right? What is going on there? What is going on with demand? So we want to, again, look at expense ratios, turnover rates, performance, right? If you buy one of these closed-end funds, you probably won't get a prospectus. So you'll want to find a prospectus for this particular investment. So again, how you choose, there's many choices, right? So if we're looking at the end, if you buy a mutual fund, what in the end do you receive back for your money? There's dividend income, right? You could receive either dividends or interest depending on the type of holdings. That could come almost on a monthly basis, and many mutual funds pay this monthly. Capital gains. The mutual fund itself, within the mutual fund, they are buying and selling securities. So there are capital gains that are earned by the fund itself. Now, you only receive these capital gains once a year. By law, mutual funds are only allowed to pay this once a year. So dividend income comes monthly, but the capital gain growth will only come once a year. Unrealized capital gains, right? This is the change in price of the mutual fund itself. And of course, this capital gain will not be taxed until you actually sell the mutual fund. So again, we can see that there's really 3 ways you can make money. You get current income, you get capital gains from the management within the mutual fund, and you also get capital gains from the growth of the mutual fund over time. So how can we calculate the holding period return? You take the shares at the end of the time frame times that price, minus the shares at the end times the initial price, and divide that by, again, the shares at the end minus the initial price. This would be the holding period return for 1 year of a mutual fund. If you think about risk, what things do we want to consider? What about market risk? Because mutual funds are so well diversified, they perform very much like the market or the segment of the market that they're targeting. So you have to be aware of the effect of the general market has on investment performance. They will be related, right? So there is a beta. We've talked about beta before. There is a beta that measures the return risk, market risk on mutual funds. Conservatively managed mutual funds tend to have less risk loss than, obviously, more aggressive funds. They tend to be more stable, right? So the risk is dependent not just on the stock market, but also on the management practices of the managers running your investment. So although mutual funds are simpler, they're easier to buy, they're easier to hold and grow than stocks and bonds might be, you still have to make some choices, and you still have to manage those choices throughout the investment period.